yields are circling the drain. Does that make sense? It's spiraling. Okay.
Yeah, I got you now. Yeah.
We had some good economic data. CPI came in a little bit hotter than consensus, not too bad. Came in at 30 basis points, as on consensus at 25. No big deal. The PPI came in actually cool, which was good. Nothing. Jobs have come in strong. So consumer sentiment came in hotter than expected. So which caused another little pop in the yields. But it's not, I don't think we're going to retreat back to sort of circling the drain here. We're not going to go back to 457, in my opinion. Knock on wood here, knock on wood, right? I don't think we're going to go to 457. I think we're going to go to probably simple Fibonacci retracements, 38.2 or 50% of that 70 basis point move. So call it a 30 basis points to about 35 basis points, somewhere in there. So if you take 388, you put 30, you put a 30 on it, there you go, 418. We're sitting at 417 this morning. So I think we're kind of at the very upper end of where the 10-year is going to go. 415 to 420, it might go to 422, it might not, but I think we're kind of there. And from there, I expect yields to roll over and retreat back. What we're seeing in the equity markets, actually, it's January 19th. We saw it yesterday and today after sort of a 3-week internal slow moving, not correction, just sort of a consolidation period, right? Is the equity markets are now starting to get ahead of the bond markets a little bit, saying, okay, we think yields are going to roll over, and obviously it's going to be good for equities. And I think there's going to be a much bigger rollover into the spring. I think that's when our small caps are really going to start to run. I think that's when the market breadth will really start to expand. We'll see the equal weight S&P outperform the cap weighted S&P.
I am really intrigued about Fibonacci, and I don't really know anything about it, and you just happened to bring it up. So I don't know if you want to talk about Fibonacci and the concepts of that in the show here, but if you know enough about it to bring it up, I'm hoping maybe you know enough about it to tell me what the heck it is. I get the concept of Fibonacci. I know it's a sequence of numbers found in nature. Is there a reason that we should be paying attention to that, or what is the reason that we should be paying attention to that in the market?
Right. So it's basically the golden ratio, 1.618. Okay. And it's effectively, if you look at population dispersions, if you look at both in animals and humans, it kind of works through these levels. In the first level of Fibonacci retracement is 23.8, 23.6. It's been a minute since I've studied all of these. Second level is 38.2. The next level is 50.
And I'm going to interject here. It's what we're kind of referring to there is almost like cycles within cycles within cycles within cycles.
Right. Right. So typically, if they're let's say you have a move of 100%, right? Typically, you'll see and there's a retracement of that move. You have levels that it will retrace to. Typically, as found in nature, as found in many different things. Okay. Again, population dispersions. It's really cool. You'll see that come down 23.8% or 38.2 or right at 50 or right, I believe the last one was 68.9 or 60, something like 69. And then above that is 100%. Okay. So you kind of see when something kind of does this and then pulls back down, it'll pull back down to one of those levels. Okay. And I think because it has to do with the mathematical relationship of the successive number and the relationship of 1.618. These trading algorithms, right? Because a lot of these big machines are now running trading operations. The yields, it measures yields, and it will buy and sell stocks and positions within portfolios at even large investment banks, large trading houses. Those are algorithmic trading mechanisms, right? We don't do that here. It's all just what's in our noggins and what our research says. But there's a lot of trading algorithms. A lot of them use Fibonacci. Okay, so because Fibonacci has happened through natural occurrences, they have now been programmed into these algorithms. So now they're even more. They're more apparent to see. You can really see them because you can actually see where the algorithm saw it at 23.8, 38.2. I'm like, okay, the machine said that's enough of it should drop to about this level based on price, based on valuation, based on what's happening in yield, based on what's happening in income, blah, 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 blah. So it should fall to about this range. Maybe the range is, 38% of the move or 35% of the move. So you'll typically see that Fibonacci number show up pretty close And that's the algorithm saying, hey, this is close enough. It's a Fibonacci number. And it's gone. So it's sort of the dog that wagged the tail, and now the tail's wagging the dog a little bit.